Welcome to the 129th season of the Canadian Club Toronto, Canada's podium. For over a century, this stage has united visionaries and leaders from politics, business, community, and the arts to share insights on the most pressing issues of our time. And with Canada in a pivotal moment, it's more important than ever that we come together.
We've been having important discussions and debates around this podium in this country for well over a century. I call this a historic podium of record.
Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, members and guests, and a warm welcome to those joining us online. My name is Shazan Chu, President of Canadian Club Toronto, and your host. Just yesterday, we welcomed the Ambassador of Canada to the United States, Mark D. Weissman, to discuss Canada's evolving relationship with the United States. Today, we continue exploring the forces shaping our economic future through a different lens. How leading institutional investors are allocating capital, balancing risk and opportunity, positioning portfolios for the long term, and interpreting the signals shaping the global economy. Our ability to host these timely and important conversations is made possible through the support of our partners and sponsors. We are grateful to have JP Morgan as our presenting sponsor today. Thank you for your support. To our season sponsors, the Canadian Bankers Association, the Carpenters Regional Council, and our airline sponsor, Air Canada, thank you as well. And to Canada's Forest Trust, our nature partner, who help us reduce our carbon footprint by planting a smart forest in our honor. Thank you. We are also pleased to welcome students from the Rotman School of Management today. And now let me take a moment to remind you of our website and its on-demand content and event information. Please visit canadianclub.org, and when you're there, consider becoming a member if you aren't already. We also appreciate it when you post about our events, so I invite you to share today's discussion on your social media platform of choice. Now, I'm sure you'll all have questions about how institutional investors are assessing risk, identifying opportunity, and positioning portfolios in today's environment. So please use the question cards that are located on your table, and for those who are joining us online, please use the Submit a Question button on the right-hand side of your screen, and our team will look out for them and share them with today's moderator. And now, it is my pleasure to invite Kash Malik, Managing Director and Head of Investor Client Management Canada at JP Morgan, to formally introduce today's panelists and moderator. Kash, Canada's podium is yours.
Thank you. Thank you, Shazan. Good afternoon, everyone. On behalf of JP Morgan and my colleagues, welcome. And thank you to the Canadian Club of Toronto for hosting this event. JP Morgan has partnered with leading Canadian platforms for over a decade to bring timely and relevant thought leadership discussions to our institutional clients. Many of them are in this room today. At a time when investors are navigating heightened economic uncertainty, geopolitical realignment, evolving trade relationships, and rapid technology disruption, the key question is, How are leading allocators deploying capital? And what are the milestones for the road ahead? This year, we are especially excited to bring both Canadian and US perspectives. First, we have Ed Cass, who's the Chief Investment Officer for CPP Investments, one of the largest asset allocators in the world and responsible for retirement security for 22 million Canadians. Ed has spent more than 18 years at CPP in various leadership roles. As a fun fact, he's an avid long-distance runner and a cyclist now, which is fitting for a steward of CPP where success is measured in decades. He has his eyes on the marathon, not the sprint. Next, we have Thomas Lee, who's the Chief Investment Officer for New York State Teachers Retirement System, one of the largest and best-funded US pension fund. This year marks almost 2 decades of him with New York Stars. Few investors have had the opportunity to steward capital as through many market cycles as Tom. And finally, we have Joyce Cheng, who's the Global Chair for JP Morgan Bank. Joyce is a total rock star. And it's not just me saying it. She has been inducted in the Fixed Income Hall of Fame, has ranked #1 25 times by Institutional Investor Survey, and is recognized as one of the most influential women in finance. Guiding today's conversation, we have Amber Kanwar, one of Canada's most respected business journalists and host of In the Money podcast. Ladies and gentlemen, please join me in welcoming the panel.
Thank you very much for that introduction. I'm very excited to get into this, and I understand we're all united by one key theme, which is that we didn't own enough SpaceX to get out of this lunch. It's up 50% in 3 days. We'll see, though, what the marathon has in store. I'd love to do a temperature check before we get into this discussion, especially because we are in a room full of investors. Just show of hands, and the panel can participate. The next 10% move, let's use the S&P 500. Who thinks the next 10% move for the S&P 500 is higher? And who thinks it's lower? Goodness, that's what makes a market, I guess. We've got kind of an even split. And maybe that speaks to how complicated it is to make sense of what is going on, because there seems like a lot in the awful column, and yet the markets keep on grinding higher. And I'll start with you, and just, do you wear rose-colored glasses when you look at the markets these days?
It's an interesting question. I appreciate that there's a division in the room, and it kind of makes sense to me. On the one hand, you have, by a lot of measures, valuations very stretched. You talk about SpaceX, and we could probably spend hours talking about SpaceX and the valuation and the setup behind the IPO. But if you take a look at traditional measures in terms of fundamentals translating through to price, it's got a lot of underlying assumptions there that you'd have to believe in to really drive value. So valuations are stretched in a lot of sectors, but on the flip side, you've got a tremendous amount of money pouring into the system, whether it's US federal government now spending a 6% deficit on $30 trillion. So it's $2 trillion coming in from public to private finances. You've got a huge CapEx boom going on in the US. I think, Joyce, by some of your estimates, it's close to $3 trillion in spending for this year. Let's say 80% is that financed through credit markets. The creation of another $2.5 trillion, you're up to $4.5 trillion going into the economy. That's a tremendous impulse. And I think a lot of people are trading off of that, just in terms of the underlying strength of the economy and where it's going. And lastly, earnings estimates are continuing to improve. So tracking those historically is kind of an interesting exercise, because analyst estimates typically come out very bullish and they kind of revise down over time. If anything, through the first 6 months of this year, you've seen estimates increase. Some estimates are north of 20% in terms of earnings growth. So again, if you take a look at traditional measures like equity risk premium, you can make the argument that, hey, it doesn't look as terrible as you'd think after the kind of rally that we've seen.
I think that's a good point about this wall of money that is coming in. There used to be a saying, don't fight the Fed, talking about the Federal Reserve, but I almost wonder if it's like Joyce, like, don't fight the Fed. So if they're spending, if they're pointing this bazooka now at the economy, follow the money.
Yeah, no, I think it is follow the money, and I wouldn't say it's so much on the Fed, but agree very much with Ed, it's on the CapEx. So just to put some numbers on this, we'd started the year thinking that the AI hyperscalers would have CapEx earnings that are 35%. First quarter came in at 70%, and non-tech was 19%. So that's kind of trumped the geopolitics. But I think the questions really are that what we see is much fatter tails. So on the left tail, it's obvious what the risks are. Higher inflation, higher fiscal deficit, higher risk premium, and growth numbers that really haven't moved much. In fact, they've moved more to the downside because of oil. But on the right-hand side, there's the hope, right? There is the AI CapEx and the investment and the spend that is going in, which is enormous. And just to put a few numbers around it, if you look at just the AI 30 companies, the S&P 500, you just look at the 30 companies, you have between the CapEx and R&D, 1.2 trillion just annually. And then you have, on Mythos and on the cybersecurity, another 1.5 trillion coming in. And then you're looking at data center financing needs where the costs keep on going up, which is another 4 to 5 trillion to the end of the decade. So that sort of has swamped everything, even more so than the Fed. But the longer term question is your right tail bigger than your left tail? So over the short term, I do think there are more reasons why the market will go up because the CapEx is coming up. But over the longer term, that is sort of the more fundamental question that I think pension funds have to ask, all of us have to ask on the institutional investor side. And one of the things where, when I look at the biggest risks, it's the size of the market itself. So US equities are now 230% of GDP. At .com, this is double what it was at .com. And you can say fair value is 70 to 100% of GDP for the size of an equity market, but you've seen companies move 10 percentage points in a day. Like if you had a 30% correction in the equity market, you wipe out 80% of US GDP. Right? We can't say there are precedents for looking at the size of the market as far as looking at past precedents.
I think that's interesting, and Tom, I'd love to pick up, for you to pick up on that point, because, and I'm going to bring it back to Ed too, I'm sure people, read in the paper, they like to beat up on the pension funds, and they like to say, just to buy the ETF, just buy the S&P 500 over the last 15 years, that would have been the right thing to do, and you don't really see discussion about diversification because you're looking at the last 15 years, and in retrospect, yeah, sure, that might have been the right thing to do, but...
But Amber, it's all the time window that you're looking at. I was appointed to this seat in November 2007. Shortly thereafter, we had the GFC. So that's where diversification really showed its benefit. So the broad equity markets were down over 30%. Because we were diversified, our fund on June 30th was down a little over 20. So our assets went from 100 billion at the peak of the GFC to about $60 billion. Today we're at 168, after paying out $8 billion a year in benefit payments. So the power compounding, the ability to stick to your asset allocation, your ability to rebalance in a diversified portfolio, it's not in these wonderful exuberant times that the benefit really makes itself shown, but it's in the volatile downward swings where, as a pension fund, that's what we need to protect against.
The exposure to private markets across pension funds and across asset allocators has increased. And where, 10, 15 years ago, it was maybe a secret, an edge. Now it seems, look how big SpaceX, Anthropic, OpenAI are able to get in the private markets. Is it still as fun? Is it still a diversifier for you? Does it still provide a buffer to the public markets that it did 10, 15 years ago?
We've never thought of private equity as a diversifier in the sense of providing a different exposure to the fund. So we try and look through asset class labels and look at the underlying economics of companies. And in that sense, private companies are no different than public companies in a lot of respects. There's obvious differences in terms of size until you get to the SpaceXs and the Anthropics and the OpenAIs. Difference in leverage historically, and some difference in terms of composition, in terms of where they play. Certain sectors that tend to prefer more than others. But in terms of the underlying drivers, I think they're exactly the same. I think you're fooling yourself if you're going into private assets as a kind of hedge against the downside purely on an accounting basis where the valuations lag. I think that's not a great game to play. That you're going to get caught out on that one over time. When we take a look at private equity, then why are we in private equity? We're in private equity because we think private equity on a risk-adjusted basis can outperform public equity. So they can add, quote, alpha. And how do they add alpha? We think it's through some combination of either being able to buy enterprises more cheaply due to good sourcing networks through value creation plans or being able to sell well. And if we take a look at those drivers and how those drivers have changed over time, we don't think they've changed materially. Certainly on the edges, and you might kind of revise down your estimate of how much alpha a private enterprise is going to yield over a public one. But we still think a lot of those drivers are in place. But it's mainly that alpha delivery that interests us more than any kind of diversifying exposure.
Do you want to add to that before I move on?
Yeah, I would say that that would apply to us too, but also for us, private equity has really been a great source of liquidity and cash flow. As I mentioned, our annual payroll is like $8 billion a year. So we rely on current income a lot. So fixed income provides that. Our equities book provides it. But private equity, because we've been doing it a long time, the contributions and distributions, even with the lag in terms of distributions today, are pretty much offsetting each other. So what we've tried to do is basically just reallocate to higher conviction managers, go from the large buyout to the mid to small, which has been a strategy that has really paid off well.
The AI trade is so dominant in what is now the S&P 500, it's like the whole Korean market basically as well, and it's becoming a bigger portion of global stocks, even if there's other sectors in there. I'd love to hear from you, each of you. The numbers are huge, there's things that are distorted, but what makes sense about this trade? Where do you find comfort? Where do you want to be exposed? Because there's no denying that the technology is here. So let's go down the line. What makes sense to you about the AI trade?
Is it the easiest place to start? What makes sense or what doesn't make sense?
No, that's how I want to start. What does make sense?
Look, as you said, the underlying technology is real, and the underlying technology is very exciting. How it's impacted markets, though, is just huge. We have this framework internally where we look at markets and we can do ex post analysis on what were the drivers of individual stock returns. And it's really interesting because we have something we call a macro factor set, and we used to be able to explain over 90% of the variance in stock returns, individual stock returns, through that lens. And about 2 years ago, we noticed, hey, it's nowhere near 90% anymore, it's down around 60%. We started asking ourselves, what are we missing? And first, because we do invest a lot in private equity, we thought, is it a small cap versus large cap thing? Because Mag 7 were kind of running wild at that point in time. We took a look at it through that lens. That helped a little bit, but it didn't explain everything. When we added something, and we've called it like an AI factor internally. So we constructed a factor that we thought kind of replicated what the AI theme in the market was. So a whole bunch of stocks on the long side that would benefit from AI, and a whole bunch of stocks on the short side that would either neutralize other exposures or be negatively impacted through AI. And we introduced that, we're back up to over 90% again. So we do a statistical decomposition, we totally want to geek out. To a principal component analysis, that's the second biggest factor driving markets over the last 2 years. So it is It's crossing all different countries, it's crossing all different sectors, and it's not in any of the risk models. So you sign up to Riskmetrics or Barra and do a decomposition. There's not an AI factor yet. If you look statistically, it's the second biggest thing driving markets in the last 2 years, or explaining variance of stocks in the last 2 years. So I think so many people are missing that. You know, we've tried to step into the market and kind of replicate that, to close the gap between the amount of weight public markets place on that factor versus what we're expressing internally within our investment portfolio.
So you take it down?
We tried to take that gap down, yes. You can ask why you do it. You know, are you hopping on this FOMO trend? I think was probably the criticism that get the most. But to me, it's not that. It's more a belief that, and this gets to your first point, that public markets are a pretty good allocator of capital. If you take a look historically, the US has been a huge beneficiary in terms of capital flows, and if you take a look at the performance of the US market over time, it's outperformed a lot of the other markets geographically. IT as a sector has outperformed other sectors and attracted a lot of capital. Markets get this right more than they get it wrong. So it's more an act of humility, I would say, to say, look, the markets are allocating a whole bunch to this new technology with beliefs that it will come through and ultimately translate through to revenues and earnings, and we should probably close that gap. But the transformational nature of the technology, I think, is widely acknowledged. But to kind of flip it on the other side, I mean, where I struggle a bit is how do you monetize it? Or who are the ultimate beneficiaries of this new technology? I think we're all sitting there waiting for, you know, in the vernacular, the killer app to come along and transform business processes, but we really haven't seen that. We've seen efficiency gains, we've seen large scale of adoption in terms of playing with it. Like, it's really, I enjoy playing with it. I'll spend a lot of time every day playing with it. But has it changed the way I do work? Has it changed the way we organize our processes? Has it led to tangible improvements and new ways of doing things? That hasn't happened yet. And if we think about SpaceX and Anthropic and OpenAI and the amount of value that's being attributable through the market to revenues in the future that haven't been identified yet, it's sizable. And I do think that poses a risk potentially to the market.
Joyce, how do you wrestle with those two things?
Well, so I think, first of all, it's very hard to say you can isolate AI from broader markets, because even you take a look at the U.S. high-grade corporate bond market, AI-related issuance is now more than U.S. bank debt issuance. That just flipped this year. You look at small cap, about 30% of it is AI-related. You talk about emerging markets, it's been, you know, Korea and Taiwan that have been the biggest drivers. So first of all, I think it's very hard to say that there is a way that you can truly sort of isolate AI as a factor. But I would just say this, you know, demand and the adoption is still you know, at stages where there's an enormous amount of growth potential. And it is increasingly seen like the existential risk is the risk of missing out on this. But I would agree with Ed. There are, in my opinion, sort of three unanswered questions about AI. So there is that, you know, adoption is still going to grow, demand is growing, the technology, the transformative capabilities are there, but then the reality that a lot of us are still using it for fairly ordinary things. But the three unanswered questions to me on it are that, first of all, what is steady state for CapEx in AI? It's not going to be 70%, and you know, just when you have these big swings and you have more households participating in equity markets, what does that mean? What is the return on investment? So right now, I think a lot of companies are just giving the instructions, we want you to adopt it, experiment with it, you know, and the third one is, what is the durable monetization model for this? There is also the cybersecurity risk. I think that Mythos in some ways has been a sort of game changer in waking people up to the fact that, you know, are we prepared for a sort of when, not if scenario on the cybersecurity side? And this is one reason why the CapEx is growing so strongly. You can't move at yesterday's pace. The market has to move at technology's pace to protect against that risk. So I do see the risk, on both sides of it. The upside over the near term just because of the CapEx numbers, and that is what drives the market. So I put my hand up when I feel that the equity market, our target is 7,600 for the S&P 500. But I also can see the downside risk because there are these unresolved questions over the longer term. And I completely agree with Tom. I mean, you need to be diversified in this environment. So whether it is some private assets, whether it is real assets increasingly in this environment with the focus on energy security, there is more of a look at the commodities market, whether it is high-grade fixed income, if you're not as comfortable with U.S. Treasuries, that diversification and being prepared for multiple outcomes and timeframes is very important right now.
And I would say that Ed and I have a tremendous advantage because we have two things going for us. One is we own the market, and two is we have time. So we don't need to really take a bet in terms of the winners and losers, because more likely than not, we have winners and losers in our current portfolio if you own beta. And the reason I say that is we worked with one of our IT info GPs, and they went through our portfolio. We came up with a framework, AI as a competitive advantage, disruptor, no impact, and we ran it through all our holdings. And not surprisingly, we have market exposure. So that's our biggest benefit, because as long as we can ride it through, our portfolios will reflect the winners, and then the winners will also be divested from our portfolios. So we don't need to make a call today in terms of where we're going to put all our chips, because over time, as our portfolios evolve and as AI evolves, more likely than not, we'll have it in our portfolio holdings.
It is interesting, though, because I think one of the risks that's starting to emerge in the market is the AI theme is being funded more and more through debt. And so you do have kind of leverage being built up within the system that at a certain point in time, I think could provide a vulnerability. And it's kind of amazing to me when you take a look across all different asset classes and you kind of sum up I'll call it maybe the temporarily non-productive asset column, whether it's cryptocurrencies, whether it's precious metals, whether it's AI companies that have a big promise of future revenues. If you have some kind of leverage crisis, this is something that we've been pondering. It's not as if you can just hold those companies or hold those assets and allow those cash flows to bail you out over time like a traditional value investor would. They look, it's okay, I traded off 50%, but I'm earning 10% cash flow. I can pay off my financing costs. If you're holding cryptocurrencies, if you're holding precious metals way above kind of next best use costs, if you're counting on SpaceX to make money 10 years out in the future, then I think that risk really increases systematically through the market.
Well, it's interesting that the big companies that are that need data centers, almost all the data centers are off their books. They're not on their books. And those of us who are in funds that invest in data centers, you're making a judgment on counterparties. So if things go badly for even the strongest counterparties, it may be a time of reckoning. So I would agree with that on that. But I find it very interesting that Microsofts of the world, the Googles of the world, they rarely have a really essential asset that are on their balance sheets.
Well, and you guys are all dancing around this issue that the shock could come from the financing environment, right? There's some sort of shock, and we can talk about whether that's inflation or whatever, and the funding closes for some reason, and it's hard to predict what that could be. And if one fails, one of the key risks or the things that make people nervous is the fact that they're all in bed with each other. Mm-hmm. They're all, OpenAI is in bed with NVIDIA, who's then lending back to them to buy the NVIDIA chips to do, that circular financing. A lot of roads, I'll use OpenAI as an example, a lot of roads lead back to one company. And is that a risk?
Yes. Who wants to start? Yeah.
could be a
I'll
very...
say, I mean, they all say, no, it's fine, because we just need to scale up. We need to get the money however we can.
Well, in a small way, that's happening in the private markets, right? So depending on the private equity fund that you're in terms of some of their trades, it's inter-GP trades, right? So Ed owns a relationship with Fund X. He gets a return because he sells it to a fund that we own, which is Fund Y, and then the daisy chain keeps continuing. How much longer that can go on is a big question mark. So I think what we really focus on is operational expertise, the good old private equity, the way it started, right? We don't rely on financial engineering. We shy away from those types of funds. Just give me good old fundamental operating improvements.
Yeah, and one dimension I just wanted to add, sort of beyond sort of the pension fund long-term view, is that, you know, since about 2023, you've seen a 50% in retail investment into equities, and increasingly in the U.S., you see that we've moved to being this capital income rather than labor income as the dominant theme. And you particularly see that amongst younger people, where just a lot of people don't feel that their income gains are going to match what the capital gains are. So a 50% increase in retail investment just in the last couple of years. And I think that itself, the size of the market and that the owners of the equities are different, you know, is a risk to also think about. And we've also seen the shift in the U.S. Treasury market, that official holdings are now less than private holdings in treasuries. And the marginal bid has become hedge funds who can do this through the swap markets pretty cheaply. So some of the risks we look at, there are the fundamental risk on the macro side, but we've also had a shift in the whole composition of the nature of the market as well.
I'm interested, do you think that's investment driven, or do you think, I almost think of it as gamification?
Well, it's also that real income gains have been stagnating at 2010 levels, whereas you've had this massive increase in asset prices off of financial markets, but in the US also out of housing appreciation, home price appreciation. So, you know, it is, you know, maybe part of this is AI, but it is not the easiest job market for young people right now. The unemployment rate, whether it is China or the US, is considerably higher for youth unemployment. A lot of the white-collar data entry jobs that are college graduates seem like they are more at risk. So there's been this gamification, that there's also this sense that you need to be an asset owner, that your real income isn't going to be enough, and that is sort of becoming the new American dream. And it's too expensive to buy a house, but I can own equities. So I do feel that, you know, compared to when I started in the marketplace in 1989, this retail investment as a bigger part of the market, that we used to think, oh, treasuries, well, all the foreign central banks buy them, but now you've had that shift as well. And these are risks that are relatively new ones to watch.
And the risk around retail is, you know, they don't have, like, it can be more volatile, they can change out, they're not maybe the long-term holders.
I think that part of it is, what I've seen with a lot of the retail money is that, first of all, what I didn't understand, my background's fixed income, is that a lot of them do not buy the fundamental story, they buy the narrative. And the narrative is AI right now. And so if I'm talking about the fiscal debt, they ask me to stop because they don't own bonds. And I say, no, this is really important. You need to understand this. You know, the second thing is, since it's increased so much since 2023, they buy the dip. This is not like they're looking to take profits. This is a relatively new thing, the amount of wealth creation that you've had coming from equity markets. So the volatility is more of an opportunity for them. And then we've seen some, you know, really interesting things even on like gender dynamics, like 38% of young men own crypto, like only 15% of women, that this sort of gamification aspect of it that you talk about. Like we see that in much of the research that's done by the JP Chase Institute that looks at some of these issues more at the household level, what is happening.
And it's
but they've been right.
Yeah, so far, but this is also pretty...
They call them dumb money, but they have made a lot of good money.
This is like cycles of looking at decades of this. You could say it's been right so far, and that is sort of the short term, that I see the CapEx numbers coming, and the earnings are what drives the market, but you can also see the buildup of risk. So once again, is your right tail going to be bigger than your left tail?
Yeah, I think it's...
And time is the ultimate judge.
No, sorry, I don't disagree. I'm playing devil's advocate, obviously.
And it's not only a phenomenon in the US or Canada, You hear it from China, the China retail investor. You hear it in India, the Indian retail investor. So the volatility in terms of their investment horizon is very, very difficult. And that also contributes to sort of like the income disparities. So those of us in this room who have the opportunity to invest in the equities market, our portfolios have done well over a long period of time. Whereas if you have no exposure to equities market and every dollar you earn is a dollar that you have, it's very, very difficult. So,
and that is why something like the Trump accounts really tap into that desire, that sort of this view that every man and woman can be a market participant. And that is different than the way one would have characterized the American dream, 30 or 40 years ago.
But I think what's interesting is the retail dynamic is generally assumed to be one where the money is very, very sticky. If you take a look at traditional wealth management models, they want to get retail money in because the retail money sticks around through the highs and the lows. And I think what's been exposed just lately is the fact that the nature of that money has changed dramatically. Like if you take a look at what happened to the BDCs and private credit, people point the finger at private credit and say that the product is bad. I mean, it wasn't the case of the product being bad, it was the delivery mechanism was bad in the sense that the BDCs got a lot of retail money coming in, which they assumed would be sticky. And what they found out was that's some of the fastest money in the market in terms of high net worth individuals moving their money around. So when bad rumors started hitting the market, everyone wanted to draw out the cash at the same point in time, and you exceeded the gates by a whole bunch. That wasn't, I don't think, anticipated at all. So the whole ability for retail, and this is why it's a gamification. Like if you take a look at sports gambling and sports betting, and then traditionally lotteries, I think the lottery money has moved into the game stocks and sports betting. But that's fast money now. It's not nearly as sticky as it used to be in the past. And I think when it comes down to liquidity again, liquidity is always the thing that kills people in the end. It's not asset price movements, it's leverage and liquidity. And I think we're underestimating the kind of sensitivity of the market to liquidity shocks.
Clearly, the U.S. markets take up a lot of oxygen, and they've been the dominant player for the last 15 years, so deservedly so. What was interesting, though, after Liberation Day last year and the Trump tariffs, something interesting started to happen in that U.S. markets were taking a backseat to global markets. Europe started to outperform. They've given that back now because of some energy shocks. Canada is outperforming the S&P 500 this year in 2026 and over the past year, not outperforming the NASDAQ, which is a bit more tech heavy. But what do we have? We've got the banks that are sitting at record highs, energy, which has been volatile, but energy was at a record high before the Strait of Hormuz, and of course gold, and a lot of commodities that in general do well in an inflationary environment. So AI, US stocks, front page stuff, but how do you think about, when you talk about diversification, where's Canada on that list? Where are commodities on that list? What role do they play in the portfolio today? And is it more exciting or less exciting than it's been in the last 5 to 10 years?
Yeah, so look, we are of the view that you're not going to see much of a bigger drop in oil prices from here, that the focus on energy, security, self-sufficiency in commodities, the demand that you're seing from AI, that you have a sort of a repricing in commodity markets where that's going to play out. And we're more worried sort of over the near term on just what happens actually in the European gas market. So I do think that you see more investors looking at ways in which it used to be that we would get a lot of conversations where diversification on private credit, but now it is looking at how do we diversify with commodities as well as a big point. But the international diversification, I'd say a couple of things, and I'd actually love Ed's views on this as well, is the international diversification I think is really important, but I also think that this weaker dollar trend is probably not going to, it was something that was actually not that weak last year, but probably that we have seen sort of that trade pass at this point. Just given where the U.S. growth differential, yield differential is at, a bias to hike rather than to cut rates. I think you're back to the dollar weakness not being, a big story here. That still, that doesn't, wipe out the need for international, diversification, but I don't think the weak dollar is necessarily the trade that, has that much more momentum over the near term. But I think what you're seeing is internationally, whether it is investment in defense in Europe, or the Middle East in rebuilding infrastructure, or Asia on a lot of the AI demand, the CapEx everywhere is looking very strong. And so it's hard for me to think of a point where we've seen such easy financial conditions. It's not just that capital is available, it's customizable. It's available in public and private markets. Then you've got the growth of digital assets as well. So, one of the things that really just does differentiate in this period of greater, geopolitical uncertainty is just, the easy financial conditions.
Yeah, just quickly, I think it's a really interesting dynamic because obviously last year you had Liberation Day, and I think everyone woke up and said, what percentage of my assets do I have in the US? And kind of shocked when they ran their risk reports because the US had been trading so strongly for so long. And the knee-jerk reaction, I don't think was as much to sell US assets, it was to hedge the US dollar. So you had a whole bunch of people, what is my appropriate exposure to the US and what's my appropriate hedge ratio? And I think your point is a good one. The US has soaked up so much capital and still is a big demander of capital and still is the highest producing economy in the world. So you see capital flows still maintaining in the US, but people, I think, leverage short the US dollar. And there's kind of one outlier trade for the next year, be on the side of its potential US dollar appreciation as a kind of liquidity squeeze, because a situation in which you have a whole bunch of people hedging US dollar assets through derivative instruments doesn't typically end up well.
Well, our liabilities are in USD, so...
Yeah, you're lucky. You escaped most of this.
We escaped most of it.
Before we wrap up, we got a great question from the audience, and it speaks to kind of pendulum swings, right? We've seen the pendulum swing with ESG investing, pro, now all the way on the other side. Ironically, those businesses have probably never been in better shape, just as everybody's sort of dropping them. But the same with globalization and deglobalization. And as pension funds who do, or investors who think for the long term, everybody takes today's deglobalization and nearshoring, and even in Mark Carney's speech, he talks, this is the new normal, and this is the way things are. The world has reshaped, and so you need to basically invest accordingly. As long-term investors who can ride out administrations and governments, how do you think about that fracturing?
Well, you want to go first? Yeah.
So our theme for 2026 is, I call it 6 Ds for 2026. So deficits, deregulation, depopulation, which the pension funds can. Depopulation, demographics.
Yeah.
De-dollarization, deglobalization, and decarbonization, with energy security driven. So of those 6 Ds, I actually worry the least, but they're written about the most, about deglobalization and de-dollarization. I mean, exports were up 6% last year. Globally, there has been not trade capitulation, but diversification. De-dollarization is not happening. It is happening by central banks, but there has been so much purchases of dollar assets on the private sector that that's not happening. Depopulation, the demographics, is actually what I think is most underappreciated. Now, the 3 that are moving at the fastest pace, though, are deficits, deregulation, which is actually very important because even if the Fed doesn't cut rates, you've had deregulation on banks, on digital assets, which is providing a boost there. And then you've got the decarbonization, your ESG question. And I was in China recently, and they have been, they're so diversified on what they have in the commodity mix, because they have coal, they have been the biggest producer of electricity and consumer. And they have the clean energy isn't a global story, it's been a China story. So their EV usage on the road, I mean, some reports are it's up as much as 55%. So it's kind of put clean energy, I think, back on the map, that you need to be diversified again. Again, we've talked about diversification here. So I think that deglobalization has been reorientation of trade, but not backing away from trade. A lot of the reshoring is really slow moving. If you look at like mining projects in the US, you can say, oh, it could take 29 years. So then it's been just sort of trading partners. And you've seen that in emerging markets, a lot of trade has been redirected there, but not cut back. So the export numbers haven't gone down. So I feel like the stuff that's talked about the most sometimes is what I worry about the least of my 6 Ds. The deficits, I'm a fixed income person, I worry about the most, but the demographics, and particularly like Tom was saying, his oldest payout is to somebody who's 108 years old. So you think about like these retirement systems were built for retirement for 10 to 15 years, not 30 years.
40, 50.
40, or yeah, 40, 50.
50.
I wasn't going that far, but Tom can talk more about this.
And it's mostly females.
Yes,
So,
and that is the big wealth transfer that, by the end of this decade, we think that women will have $34 trillion, and well, if they live 5 years longer than men, and are we prepared for that? Have we thought about just that big wealth transfer that's going to be female managed?
Yeah, I don't think of deglobalization itself being that big a factor, but the problem for me is it's in the same direction as all your other Ds. And I'll add like defense to that as well.
Yeah.
And debt.
Yeah, in 2027, I can do 7 Ds for 2027 defense.
But all these things, all these things require money. And the demand for capital is just off the charts. If you take a look across government financing, the CapEx build on AI, the energy infrastructure that has to go into place, the defense initiatives that countries have announced, deglobalization where you're near shore, everything. All this requires capital. And I think the big risk to markets is just the price of the real rate gets repriced dramatically a lot more quickly than people think, because that should hit all asset prices. You've had a period where real rates adjusted from what we saw at the height of the pandemic, obviously, got like minus 150 basis points. Up to at the US, you at one point hit positive 250. So you saw a 400 basis point shift in real rates. That was largely absorbed because the economy grew so strongly, but I'm not as convinced that that story plays out again. If you got another huge real rate shock, that would translate to earnings necessarily.
Yeah, and like in the US, the assumptions on Social Security assume Treasury yields at 3.8%, which we haven't been at for a couple of years.
Social Security, isn't that dead?
Yeah, but it is that, when everybody talks about the Social Security cliff, you're gonna hit that sooner with Treasury yields running where they're at. And everybody talks about the growth, but our growth has stayed at this like sort of 2 to 2.5% handle for everything we've talked about. Like if you just took a look at US numbers, you would see 2 to 2.5% growth, 3% inflation, 6% fiscal deficit for the last couple of years. You never would have guessed that the asset prices went up as much as they did just if you look at the macro numbers.
I'm gonna end because we only have a minute left, but I love to leave our guests with something tangible. And we've had a lot of great discussion. Let's say I'm gonna pin you down 3 years. You gotta hold something for 3 years. High conviction. Where do you feel safest? Where do you feel warm and fuzzy for 3 years? Let's go down the line.
Where it feels safest? Cash. Okay. That was an easy one.
No, look, I think that high-grade bonds with a higher yield than Treasury actually are, a good place to have diversification, even if it sounds kind of boring. I actually think gold is going to do fine here. The demand, the particular central bank demand, is going to remain, strong. But I wouldn't be short U.S. equities. I think the volatility is going to be really high, though. Higher than what we have seen, just given some of the questions that we haven't been able to answer here on the nature of the investment.
I would say multifamily income-producing properties with low vacancy rates in areas that have eds and meds.
Cash, gold, and low-risk real estate. I think that tells you something about how our panelists feel about the current market conditions. Thank you so much for your insights and for being so generous with your time. Stay seated. Stay seated.
Amber, thank you for leading today's conversation with such insight and energy. Yeah, sit. have a seat. Oh, yes. Edwin, Joyce, and Tom, thank you for sharing your perspectives on how institutional investors are navigating uncertainty and positioning for long-term success. Before we conclude, we have one final order of business. Earlier today, thanks to the generosity of our partners at Air Canada, we invited those in the room to enter into a draw for 2 return tickets to anywhere in North America. And the winner is, drumroll, Saba Auji. Oh, that's okay, Saba. The team will give you the tickets. Congrats. And now I'd like to take a moment to recognize that this is our final event of the 25-26 season and my final event as president of Canadian Club Toronto. I would first like to thank today's presenting sponsor, JP Morgan, for making this important discussion possible. And I'd also like to recognize our season sponsors, the Canadian Bankers Association, Carpenters Regional Council, and our official airline sponsor, Air Canada, and to Canada Forest Trust for their support throughout the year. And to our AV partner, VVC Live, thank you for your outstanding support through the whole season. Thank you. I always look over there for you're online. On behalf of Canadian Club Toronto, thank you to our members, sponsors, partners, volunteers, speakers, and guests. Your support helped to make this an extraordinary year. Together, we have welcomed the Prime Minister of Canada, the Premier of Ontario, the Mayor of Toronto, CEOs, investors, policymakers, Indigenous leaders, and many other remarkable voices helping us to better understand issues shaping our economy, our country, and our future. Thank you for your engagement, your curiosity, and your commitment to issues that matter. While today's event brings this season to a close, I'm pleased to share that our team is already hard at work planning an incredible lineup for next year. We look forward to sharing more in the months ahead. Have a wonderful summer. Thank you.